I have a brief statement, and then I'll be happy to respond to your questions. The job market remains strong, the economy continues to expand, and inflation appears to be moving toward the FOMC's 2% longer run goal. As you already know, we decided today to raise the target rate for the federal funds rate by 1/4 percentage point, bringing it to 1.5 to 1.75%. This decision marks another step in the ongoing process of gradually scaling back monetary policy accommodation, a process that has been underway for several years now. Job gains averaged 240,000 per month over the past 3 months, well above the pace needed in the longer run to absorb new entrants into the labor force. The unemployment rate remained low in February at 4.1%, while the labor force participation rate moved higher. Over the past 4 years, the participation rate has remained roughly unchanged. That's a sign of improvement, given that the aging of our population is putting downward pressure on the participation rate, and we expect that the job market will remain strong. Although the growth rates of household spending and business investment appear to have moderated early this year, gains in the fourth quarter were strong, and the fundamentals underpinning demand remained solid. Indeed, the economic outlook has strengthened in recent months. Several factors are supporting the outlook. Fiscal policy has become more stimulative. Ongoing job gains are boosting incomes and confidence. Foreign growth is on a firm trajectory, and overall financial conditions remain accommodative. Against this backdrop, inflation remains below our 2% longer run objective. Overall consumer prices, as measured by the price index for personal consumption expenditures, increased 1.7% in the 12 months ending in January. The core price index, which excludes the prices of energy and food and is typically a better indicator of future inflation, rose 1.5% over the same period. However, as we have noted for some time, the shortfall of inflation from 2% reflects, at least partly, some unusual price declines that occurred nearly a year ago. In coming months, as those earlier declines drop out of the calculation, inflation should move up closer to 2% and stabilize around that level over the medium term. Of course, various forces will continue to affect inflation. At times, it may be above 2%, just as at times it may be below. Our inflation objective is symmetric in the sense that we are trying to prevent persistent deviations from 2% in either direction.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.